Good morning traders, it's Carlo from Blueberry's trading floor with your week ahead and also what is top of mind for traders right now. Obviously it's the Middle East crisis and its impact on oil prices, inflation and US Treasury bonds that have been battered last week with US 10-year bond yields rising to 4.4%. As a result, gold was hit, silver down 7%, Bitcoin was down, oil prices pushed higher again, above $100 a barrel for West Texas crude, and US share markets and global share markets were down 2 to 3% across the board. Crucially, President Trump has given Iran 48 hours to reopen the Strait of Hormuz. However, the Iranians have fought back, saying that they insist on a ceasefire before even talking about reopening the Strait of Hormuz. So this is further escalating matters in the Middle East, which is likely to keep oil prices quite elevated. Before we move to the economic data this week, the key driver for markets has been central banks' statements and comments last week and going forward most likely. So what we've seen in the past 2 weeks, we've seen first off, the RBA increase the cash rate by another 25 basis points to 4.1% and also talking about upside risks to inflation. So they remain hawkish. And last week, crucially, the Federal Reserve out of the States, the European Central Bank and the Bank of England all turned hawkish, all identifying upside risks to oil prices and inflation, and also concern about growth going forward. So these are the key issues that are front and mind for traders and also investors for the weeks ahead. This week, we're quite light on economic data. Tuesday, Wednesday nights, we do have a spate of PMI data out of Europe, particularly Germany, as you can see on the screen, and United States. But more importantly, it's Wednesday, Australian time, 11:30 a.m. You see the monthly Australian CPI data. Now, the headline CPI in Australia is running at 3.8%. The trim mean that the Reserve Bank of Australia looks at a lot more is running at 3.4%. So those two measures are still very much elevated and well above the Reserve Bank's 2 to 3% target band. But that'll be a key data point for this week, followed by Wednesday evening UK CPI, expected to be around about 3% annualised, and ending the week with UK retail sales. As I said, quite a light week in terms of US data, and of course, all the focus remains on the Middle East. First chart is a gold daily chart. So what is happening to gold right now? It's just above 4,500. Gold has fallen quite sharply from last week. In fact, it's down about 10.7%, and gold is down 20% since the highs made on the 29th of January, when it almost reached 5,600 an ounce. Why is gold lower and sharply over the last week or so? A couple of points. One, a stronger US dollar. Why? Obviously, markets have started to reprice Fed rate cuts this year. In fact, about a month and a half ago, there were 2 Fed rate cuts factored in for 2026. Now, with the sustained move high in oil prices, which have increased inflation expectations, the markets have priced out any rate cuts at all in the United States, therefore pushing up US bond yields and pushing up shorter term yields as well in the States. Therefore, higher US yields, higher US dollars, and the gold price has suffered. In addition, traders have de-risked. They've taken some risk off the table and they've looked at products where they've held for quite some time, and that has been gold, silver, also Bitcoin, and those products are suffering right now. The technical picture also looks quite weak. The 20-day EMA and 50-day EMA are about to cross. They haven't crossed yet, but the crossover is possibly in play. In terms of downside targets, we've had 1, 2, 3, 4 daily candles here, which bottomed out around 4,315.20, that area there, and that looks to be the immediate key support level for gold prices, at least for the next few trading sessions. The recent downtrend in gold prices on the daily chart are further supported by the stochastic oscillator falling sharply and remaining below the 20 level. For traders looking to trade gold going forward, as mentioned, first key level to keep in mind is horizontal support around that 4,300, 320 mark. Resistance is likely to be towards the top of the previous candle, Friday's candle, around about 4,730. Next, I'd like to take a look at equity markets, in particular US equity markets, with the S&P 500 daily in front of me. Now, during this period of Middle East crisis, one would expect that equities don't do so well. Obviously, higher oil prices are negative, higher inflationary expectations, higher US bond yields, all in themselves act as a negative for US equities. And fundamentally, that is what we're seeing right now. The technical picture also supports that. We're seeing the downtrend in the S&P 500 accelerate. By that, I mean the 20-day EMA has crossed over weeks ago and is diverging away from the 50-day EMA with support from stochastic's oscillator, which has dropped sharply below the 20 level. But the fundamentals and technicals have supported a strong downtrend in the S&P 500. For traders, well, traders might be interested in trading a 5-minute chart or 30-minute chart, shorter term charts, but in terms of the bigger picture, where to from here? Well, crucially, we had a double bottom for the S&P 500 around that 6,500 mark. But this is where we are right now, and we're actually trading just below 6,500. Can we move further in the next 24 hours and close below there? I think a weak close is quite important for traders, and it could signal further downside pressures in the S&P 500 and US equities in general. If that happens, and if that is the case, and for traders who are looking for further downside levels, you can look at the horizontal support level here around 6,200. We can see here we've had multiple lows around this level. In terms of if we do get any kind of positive news over the next 48 hours and stocks do have a relief bounce, where could we go from here? First of all, the tops of the two previous candles around 6,640, and then you've got the 20-day EMA around 6,700. So those are levels to keep in mind for traders trading the S&P 500. Finally, let's take a look at the Aussie dollar chart on the dailies. Now, the Aussie has generally been an uptrend for the first part of this year, and then we've seen a lot of choppy sideways price action. We did make a high of around 71.85 just a week and a half ago, and that was following the second Reserve Bank rate hike for this year. Now, cash rates are 4.1%. US Fed fund rates are unchanged at 3.5 to 3.75, so the Aussie yields are higher than US. There's a bit of a carry there for being long the Australian dollar versus US, and overall, that is one of the main reasons why the Aussie has held onto its gains against the USD due to higher yields. But there are two competing forces at play here. One, as mentioned, higher Aussie yields recently, and two, the US dollar has gained during the Middle East war crisis, with high oil prices leading to the markets factoring out any rate cuts in the States. In fact, bond yields have pushed higher. So for this week, we do have the monthly CPI data in Australia for February. If that is higher than expected, one would expect the Aussie might catch another bid tone in the short term as well. Now, levels to keep in mind for traders trading the Aussie short term. You can see here in blue, the 50-day exponential moving average has acted as decent support for the majority of 2026, and that comes in around 69.80, just 20 pips or 25 pips below where we are right now. In terms of resistance, well, the Aussie can move. It does catch a big tone. Resistance remains previous highs around 71.85. That's the week ahead in my analysis for the week. As always, keep an eye out for any central bank comments and developments across the Middle East. Good luck with your trading. Thanks for watching, and I'll see you in the next video.